You must have always heard that value of a company is equals to the present value of its future earnings. But has anyone told you at what rate you need to discount your future earnings to make it present value? Let me tell you. So we discount FCFF, that is future earnings, by WACC, weighted average cost of capital. Now the formula for the same is weighted average cost of capital is equals to weight of debt into after tax cost of debt plus weight of equity into cost of equity. Now cost of debt, that is something that you will get in the annual reports of your company. Cost of equity is something we will calculate using CAPM method. Now there are two factors that we need to consider by calculating cost of equity. The first is how much riskier my business is, and the second is what is the opportunity cost of the investor. Now the second factor is something that cannot be molded into a math formula. So CAPM is a model that calculates the riskiness of a stock and calculates COE based on it. Now, how do we calculate the riskiness of a stock? We calculate it using a concept called beta. So let's imagine how much return would we need on our investment. So we will need at least 7% return, because that is something that government gives risk free on its risk free bonds. Now that is bond. We are investing in equities. So if we take the market average, that is Nifty gives 12% return. Now this gap between 12 minus 7 is called the equity risk premium. That is something we are, because we are investing in equity, because we are taking the risk of investing in equity, that is something we expect to get as an extra returns. And but we are not investing in the market, we are investing in a stock. So that is something even riskier than the market. So in order to calculate the risk of a stock, what we do is we find out how much volatile it is in relation to the market, and that is called as the concept of beta. It determines how much more it is riskier by calculating how much more volatile it is. Now the formula for CAPM is risk-free return plus beta into risk-free return minus market return. So that is the formula of cost of equity. This was it for today. Hope you liked it. Here is a question for you. What is the limitation of the CAPM model? Drop your answers in the comment section. Thank you.